Well, greetings, everyone. We're happy to have you on today's financial planning webcast. I'm Nick Breit, a partner in the Wealth Office. Delighted to be joined by Sarah Hinman, a principal in our Wealth Office. We're excited to share select planning considerations from our 2024 financial planning guide. Due to time constraints today, we won't be able to review all the considerations from our guide. So we do recommend that you download the full guide as time permits, just to go through all of the considerations in greater detail. Our goal for today is to provide timely and actionable planning considerations for a broader audience. We'll carve out roughly 40 minutes walking through planning opportunities covering tax and charitable planning, retirement planning, legacy planning, and then finally risk management. We'll then reserve the final 5 to 10 minutes for question and answer at the end, so please do use the chat box to enter any questions, and we'll do our best to answer questions at the very end of today's presentation. Finally, attendees will have the opportunity to earn 1 hour of continuing education credit. So if interested, please be sure to use the linked form in the chat box. And with that, Sarah, I'll turn it over to you.
Thank you, Nick. As many of you know or may not know, Nick and I are part of our broader Wealth Office team here at Fiducient Advisors. We service private clients across the nation in over 40 states. We're a highly credentialed team. We're currently managing about $22 billion in assets under advisement with 8 offices around the nation. Nick is representing our Chicago office today, and I am representing our Salt Lake City, Utah office also. Taking a bigger picture view as Fiducient Advisors in totality, we are currently advising on assets north of $280 billion across 5 different business lines, including private clients in the Wealth Office, but also endowment and foundations, defined contribution plans, defined benefit plans, as well as financial institutions.
As noted earlier, we encourage you to download a full copy of the guide. If you haven't done so already, you can certainly find it available on our website under our Insights tab. Before we begin, we wanted to point your attention to our wellness scorecard, which we include in the guide, which we consider to be a really handy tool as you're working through the guide, just to think personally, what are areas that are perhaps up to date where perhaps no further action is needed, versus areas that may have fallen off the radar and perhaps need to be revised or updated. So again, a really handy tool to use as you work your way through the guide. With that, we'll turn our attention to tax planning and focusing specifically on quick takes for the new year. The first would be, we expect the Tax Cuts and Jobs Act, given the fact that personal tax provisions under TCJA are set to expire in early 2026. We expect an increased focus on tax legislation this year, given the fact that we're in an election year. From our perspective, 2024 presents a nice window of opportunity for taxpayers to reassess planning strategies, just given some favorable tax provisions, again, that are set to expire on the personal side at the end of 2025. From a gifting perspective, the good news is there's additional capacity for gifting. The lifetime gift tax exemption increased pretty materially year over year. So in 2024, it increased another $690,000 to a new limit of $13.61 million per person. The takeaway here being individuals who had previously exhausted their lifetime gifting exemption may now find additional room to get extra assets out of their taxable estate. Do keep in mind that this much elevated amount is set to sunset after 2025, barring any type of extension by Congress to the favorable level. So it could potentially drop to an inflation-adjusted amount of perhaps $7 million per person. Under TCJA, the standard deduction roughly doubled. So the percentage of Americans that are itemizing deductions has fallen pretty materially over the last several years. Prior to TCJA, it was estimated that roughly 30% of taxpayers itemized deductions. Currently, it's estimated that that number is closer to 11%. So because of that increased standard deduction, it's a little bit harder to exceed that standard deduction hurdle to get to an itemized deduction amount. So with that in mind, we're seeing charitable bunching remaining a very effective strategy. And what I mean by charitable bunching is you're giving multiple years worth of charitable gifts into a single tax year to provide a very large itemized deduction total. And then in subsequent years, you're opting for the standard deduction. So putting this into dollar terms, the standard deduction in 2024 for a married couple is a little north of $29,000. let's say a couple gives $20,000 per year to charity, they might actually find that their charitable gifts are just barely helping them get above that standard deduction hurdle. So in an example such as that, you might benefit from that charitable bunching strategy, again, where you're front loading multiple years worth of charitable gifts into a single tax year. We often see this strategy utilized with a donor advised fund or a private foundation for this purpose. And then finally, we continue to see intra-family loans remain very popular. Given the elevated interest rate environment, while rates have come down from late last year, still becomes somewhat of a costly proposition on the traditional mortgage financing side. So a 30-year fixed mortgage still roughly 7%. In contrast, under intra-family loans, those loans have a minimum interest rate that must be charged, which is governed by what's called the applicable federal rate. The spread or differential between the AFR rate and a traditional 30-year mortgage is almost 3%. So you're talking a difference of almost a 7% on the traditional mortgage side versus a little more than 4% on an intra-family loan. So again, provides a very cost-effective route to helping loved ones finance a home purchase. One of the planning considerations we always love to share with clients is really to compare how your tax picture compares to prior years, as year-over-year income tax variability can provide valuable planning opportunities. So what do we mean by that? In higher than normal taxable income years, you'd benefit from accelerating deductions, maximizing retirement contributions, and trying to hold off on certain income items, such as the sale of a business, stock option exercises, and being thoughtful in managing realized capital gains, and then to the extent possible, harvesting any tax losses. Conversely, in lower than normal taxable income years, it may pay off to defer itemized deductions and in particular charitable gifts, while potentially accelerating certain income items such as the sale of a business, stock option exercises, potentially realizing capital gains up to a certain income threshold, and potentially considering a Roth conversion. Investors sometimes overlook the importance of tax efficiency as it relates to their portfolio. And what we mean by that is if you take a step back and think about all the different asset classes that constitute a diversified portfolio, the reality is asset classes produce income that's taxed at different rates. So certain asset classes are more tax efficient than others, and we've laid those out to give some perspective here on this slide. So starting with the most tax efficient, we have municipal bonds, which produces income that's federally tax exempt and maybe state tax exempt. Next, we look at global equities, which typically produce income that's taxed at very favorable qualified dividend rates, typically at a 15 or 20% rate. And then as we shade into less tax efficient asset classes, you can think of things like bonds or real estate, which produce income taxed at ordinary income rates. So putting this into practice from a portfolio perspective, we encourage clients to think about their portfolio really being comprised of three different buckets. So a Roth account, traditional retirement accounts, and then finally taxable accounts. So the first stop in constructing a well-built asset allocation is really having a key focus on what we call asset location. So within Roth accounts, we want to allocate to higher growth strategies, primarily focusing on global equities and other high growth strategies. You may give additional consideration to higher turnover actively managed equity strategies. Next, we would look at traditional retirement accounts, allocating to tax inefficient asset classes there. So really focusing on those asset classes that I noted earlier that produce income taxed at ordinary income rates. So the first tier would be high yield bonds and dynamic bonds, followed by US core taxable bonds and REITs or real estate. And then finally, global bonds and inflation protected bonds. And then finally, we look at the taxable account to really blend out the portfolio to get to the desired target allocation. So what are key questions you should be asking your advisor as it relates to tax planning? First, are your itemized deductions providing significant tax savings? Here specifically, we draw your attention to the net tax savings provided by any charitable gifts or your charitable deduction, and consider whether you might benefit from a charitable bunching strategy as I referenced earlier. Next, is your portfolio allocated for tax efficiency? So really assessing how is the portfolio allocated across those three different buckets: Roth accounts, traditional retirement accounts, and taxable accounts. And then finally, how might your tax picture change after retirement? Really important to have those discussions with your advisor in the years leading up to retirement as you assess your current tax picture as well as what your tax picture might look like after retirement. For those that are in the top tax bracket and will continue to be in the top tax bracket for the foreseeable future, perhaps less planning opportunities. Conversely, individuals that are in a very high tax bracket, but assume that their tax picture will drop pretty materially post-retirement, there could be some planning opportunities. A great example of this is we had a client who was in the top 37% federal income tax bracket, had a very large income year due to various bonuses and payouts. The individual is charitably inclined, and post-retirement, this individual assumed that they were going to fall somewhere in the 24 or 32% tax bracket. So we said, because you're charitably inclined, why don't we front load a lot of those charitable gifts while you're in the 37% tax bracket, rather than waiting till you're in the 24 or 32% bracket for future charitable gifts. Client executed donor advised fund, front loaded those charitable gifts, and it provided a tremendous tax savings. With that, pivoting into charitable planning, the good news is Americans continue to remain extremely charitable, as we've summarized here in the chart in the upper left. And the reality is that individuals comprise a pretty significant portion of charitable giving. A 2023 study pointed to individuals accounting for about 64% of charitable gifts. Certainly, there's the tax benefit associated with charitable gifts. That's a strong incentive. But more than anything, it's really the psychological value and the emotional value of knowing that you're making a difference and contributing to causes that you're passionate about. Individuals really have a variety of avenues to consider as it relates to the charitable giving front. So many individuals opt for the convenience of simply writing a check or making a cash or credit card donation, but there are other avenues. So I had highlighted briefly before donor advised funds, which continue to grow in popularity, where you're making a charitable gift and getting the tax deduction in a single tax year, and then choosing to make subsequent gifts at a pace of your choosing. Private foundations, somewhat similar in respect, although some different tax treatment when we're looking at the tax deductibility for contributions to a donor advised fund versus a private foundation. For some individuals, they choose to go one step further and use advanced planning strategies, that being charitable lead trust or charitable remainder trusts.
Yeah. Nick, you gave a really great example just a little bit ago about a client who was getting ready for retirement and had an opportunity to do that donor advised fund before retirement. Are there any additional kind of key planning opportunities for those that already may be in retirement, particularly around using their IRAs?
Yeah, that's a great question, Sarah. So there's something called the Qualified Charitable Distribution, or QCD, that's available to taxpayers who are age 70 and a half or older. 2024 is the first year where it's indexed for inflation. So you can give up to $105,000 per year from your IRA directly to charity. Now, that distribution counts towards satisfying your RMD, but doesn't count as taxable income. So we have seen certain situations where taxpayers who are charitably inclined have utilized their IRA actually for charitable gifting purposes.
Yeah, that's a great planning opportunity for sure.
It really is.
Mm-hmm.
And then finally, what are key questions you should be asking your advisor on the charitable planning front? First, for some individuals, it's where should you even start? We typically point to where have you spent time in the past volunteering, or perhaps what values would you like to pass on to the next generation? What causes are you really passionate about? Next, what type of assets should you consider gifting? So we touched on that a lot of individuals will accomplish charitable giving by writing a check or making a cash donation, but that may not be the most preferable route. We often help clients on the charitable front by gifting long-term appreciated securities from a taxable account. And the net benefit there is the charity still receives the same monetary value, whether it's appreciated securities or a cash donation, but the donor avoids paying capital gains tax on the gifted security. And it can have the added benefit of helping to rebalance the portfolio or pare back exposure to a concentrated position. And then finally, what charitable giving vehicle is right for me? Again, for some individuals, it might be outright gifts, but we continue to see donor advised funds and private foundations remain a very popular avenue for individuals on the charitable giving front. With that, Sarah, I think we should pivot into retirement planning. Certainly a tough concept for a lot of individuals to tackle, just given all the considerations involved. So what are key things individuals should be keeping in mind on the retirement planning front?
Yeah, thanks, Nick. Right. That is the key question that we're working on with clients, right? Do you have enough to retire? And if you're in retirement, do you have enough for the rest of your life to support your living needs and so forth? So, a couple of key things that you want to think about top of mind are the longevity and healthcare costs, particularly as you're thinking about building your retirement plan. So, on average, here in the US, biological males and females live to about age 82, age 84, respectively. Although you'll certainly want to keep in mind any health concerns or conditions that you currently have, and as well your family history in terms of longevity, and err on the side of caution in projecting a longer life than perhaps what's here noted on average. And then also when we're thinking about healthcare costs, I was just having a client conversation yesterday around the potential healthcare costs to incur during retirement here in the US. On average, for individuals over age 65, the amount is $157,500 during the course of your retirement. And that does not include long-term care expenses. So definitely something that you want to keep front of mind as you're preparing for retirement as well. So if you're working today, right, the question is, are you saving enough, right? How do you know if you're on track and saving for retirement? And so we've outlined here a quick checkpoint for reference, which is a good check-in at this time of the year. Beginning of the year is part of your overall financial wellness check-in. So let's say you're age 35, you're making $200,000. How much should you have saved for retirement? If you take $200,000, reference your age 35 here on the screen, you'll want to multiply that number by 2 to get to an estimated portfolio retirement savings of $400,000. So take that $400,000, compare it to what you currently have. Are you under target? If so, you'll want to perhaps increase your retirement savings to get back onto target. Or are you on track with saving for retirement? I think this really helps to highlight some of the common mistakes that we see in saving for retirement, and that is saving too little and starting too late. So we really can't stress enough the importance of doing this exercise, checking in, making sure you're on track for saving for retirement. But what about if you're already in retirement? How do you know how much is a prudent amount to spend from your portfolio on an ongoing basis? Generally, you might hear in the industry or comments from your financial advisor as to the 4% spending rule, meaning that you take your year-end portfolio balance, multiply by 4%, and that's the amount you can withdraw for income needs throughout the year on a very, very safe assumption for longer term retirement. However, depending on your time horizon, your portfolio allocation, and risk tolerance, 4% might not be the most prudent spending amount. So we've highlighted here the variances in time horizon that individuals might have over the course of their retirement, and different portfolio allocations ranging from a more conservative portfolio to a more moderately aggressive portfolio. As you can see by the spectrum of spending rates here, if the 4% might not be the most relevant number for you. So you'll want to be sure you check in with your financial advisor, check in regarding your expected time horizon for retirement, circling back to that longevity conversation, and make sure you're appropriately spending from your portfolio for the entirety of your retirement. And so for individuals, both saving for retirement and in retirement, how do you think about the different buckets that you have accordingly? So Nick was referencing a little bit earlier regarding the different optionality you have in optimizing your portfolio allocation, but you also want to think about the opportunities you have for saving and sourcing these different types of buckets during retirement. So as Nick mentioned earlier, right, you have your traditional retirement accounts that are pre-tax. You have your taxable accounts, which will still have interest, dividends, and capital gains that are taxed, but are generally considered after-tax dollars. And then you have your tax-free bucket. So the Roth IRAs, the Roth 401k portions of your of your portfolio. Again, earnings are not taxable in those types of accounts, but qualified withdrawals are not taxable during the course of your retirement.
So there's a question here in the chat box for someone planning for retirement that could still be many years away. How do you prioritize between funding and investing in these different piggy banks that you have listed here on the slide?
Sure, that's a really good question. And if you think about first the end game, right? If you're in retirement and you have a diversified set of assets across these different types of buckets, you have more optionality and flexibility in managing your taxable income, just like you were referencing earlier. So as you're building these buckets, you want to think about having a diversified allocation across these buckets. And in particular, if you look into your employer plan optionality, you may have the feature to select partial contributions to pre-tax and partial contributions to after-tax. And that's a strategy we see many of our clients take advantage of to build that diversified allocation across pre-tax and no-tax buckets. And then you'll want to think about if you're not on track for saving for retirement, but you've already maxed out your 401k or 403b retirement plan contributions, the next step then will be to shore up your taxable accounts. So be sure you have a substantial amount in that taxable account bucket to help navigate the retirement budget for you longer term. One other component that we'll mention, and there's much more in the broader financial planning guide regarding this conversation, is about stock compensation. So stock compensation, if you have access to those types of benefits, if it's managed correctly, it can very much help in achieving your longer term success. When we're looking at executives in particular, on average, we see equity compensation comprising 59% of an executive's total compensation. However, only 45% of executives generally end up exercising all of the granted options before they expire. So perhaps a missed opportunity that you need to be keeping track of and could add substantially to your longer term financial success. As you can see here from the graphic on the screen, it is a very complex space. So you'll definitely want to be sure you check in with your financial advisor and also loop in your tax advisor as well regarding how to manage your stock compensation. So all in, the questions again you want to be asking yourself and your financial advisor is, before you retire, do you have enough savings to retire? We've outlined here some quick and general checkpoints, but you really want to do a more detailed exercise and run a Monte Carlo simulation to really test whether or not you have enough savings to retire. Speaking back to the variances in prudent spending rates based on the type of portfolio allocation that you have. You'll also want to check in with your financial advisor, understand the risk tolerance in your portfolio, and if it's really structured to meet your longer term goals and needs. And then once you're in retirement, you'll want to be sure you check back in on that retirement plan that's more detailed and specific to you to make sure you're ensuring the savings you have and have worked so hard to build over your lifetime will last for the rest of your retirement and keep up with your income needs over time. That being said, one of the other key questions that we commonly receive from clients and is a once in a lifetime decision is what to do surrounding Social Security and Medicare choices. So we've outlined here some key considerations to think about when choosing when to begin Social Security benefits. Again, this is a once in a lifetime choice, and so you'll want to make that decision appropriately and prudently. So let's take an example. Let's say your full retirement age per the Social Security guidelines is age 65. That is what's called the age of the primary insurance amount that you can get quoted from the Social Security website that we listed here, specific to your earnings record. If you choose to claim at age 67, your full retirement age, you would receive 100% of that primary insurance amount. Again, that is quoted from Social Security. However, if you have built up a taxable account savings, and perhaps you have other resources to draw upon for the first few years of your retirement, you may elect to delay your benefits up to age 70. So that would take you all the way to 3 years out. And with an 8% annual increase to your benefit, you would receive for the rest of your life 124% of that original primary insurance amount. Now, on the flip side, let's say you're actually needing some income and a little bit earlier than expected. So you can choose to claim Social Security benefits as early as age 62. But just like if you claim benefits later, the change to your benefit is a permanent change for the entirety of your lifetime. If you elect to claim early, that amount will be lower because you're collecting over a longer time period, theoretically. So if you claim as early as age 62, you would receive a 70% of your primary insurance amount on an annual basis going forward.
Sarah, we're sometimes asked, you mentioned the enhanced age 70 benefit. Okay, if I forego, 3 years in your example of benefits to wait for the enhanced benefit at age 70, how long do I have to live to really get to a break even? How should individuals think about that trade-off?
Yeah, that's a common question. And we would say generally the break-even age where it makes sense to delay it to age 70 is living to around 82, 83. However, you may want to think about some other factors to consider, right? Are you claiming just for yourself, or will your spouse need to claim spousal benefits if something happens to you, right? You'll want to consider that as part of your overall longevity conversation. You'll want to think about other income needs, other health insurance needs, changes in employment, and other family benefits as well. So a bit of a broader conversation that should be unique to your circumstances. But generally, the guidance is around living to age 82, 83.
There's a question here in the chat about the 4th year at 132%. That would only be applicable if your full retirement age was age 66, because you can only earn those enhanced benefits up to age 70.
Correct. Mm-hmm. One of the other key decisions to make, and this is at age 65, not age 66 or 67 for Social Security, is regarding the decision around Medicare. So in general, you can select to go the route of original Medicare or Medicare Advantage. Original Medicare comprises Part A and Part B Medicare. If you paid into the payroll tax system, Social Security, for 10 years, you are eligible to receive Part A, which is hospital insurance, free and clear. And then you'll want to tack on Part B Medicare, which is the part of the package that is going to cover physician services, outpatient care, all those other medical needs. And it does come with a monthly premium that is also tied to the level of taxable income that you report. So another reason why it's so important to manage your taxable income in retirement. If you're choosing original Medicare, Parts A and Part B, you'll also need to tack on a Part D plan as well, specifically for prescription drugs. And then many also tack on a supplemental policy or Medigap policy. So if you hear Plan F, Plan G, Plan H thrown around, that is the supplemental plans that are being spoken of to complement the original Medicare package offering. Now, if you'd like to go the Medicare Advantage route, that is an alternative to original Medicare. So it's more of a private health insurance offering rather than the national system. And sometimes we see prescription drug coverage included in Part C plans, other times not. So you'll want to be sure you check in and determine if a Part D, an additional Part D plan will be needed with your Part C Medicare Advantage plan. So again, some of the key questions to think about when you're chatting with your financial advisor regarding Social Security and Medicare. When should you start taking Social Security, right? Think back to longevity conversations, income needs, family benefits, and so forth. How can you check your estimated Social Security benefits, and how do you apply for Social Security benefits? All of those features are available online at the government website for Social Security. We've included links within this presentation, and it's embedded within our overall financial planning guide as well. And then what Medicare plan makes the most sense for me. So think about your current health conditions, think about the drug coverage that you might need, family history of medical issues and so forth, and check in with your advisor as to what makes the most sense, what's most sense for you for the longer part of your retirement. With that, I will turn it back over to you, Nick, to go through a little bit more on the estate planning front and trends that we're seeing in the industry today.
Fantastic. So if we think about estate planning from a high level, estate planning is really important for a variety of reasons. First, it provides protection for you during your lifetime, being able to name a power of attorney, being able to craft a living will, naming a healthcare proxy. So on a relatable basis, you can think about what in the event you are incapacitated, who do you want to make medical decisions for you, which can be specified in estate planning documents. A proper estate plan allows you to distribute wealth in accordance with your wishes, as opposed to leaving it up to state law to decide. It allows you to select responsible individuals to carry out your wishes, extremely important for those that might have minor children, but also thinking a step further, being able to name a trustee to manage assets within a trust, or being able to name an executor for the ultimate handling of a final estate. There are planning opportunities as it relates to taxes and expenses with a properly crafted estate plan. It gives you the ability to really create a philanthropic legacy. So you may be able to incorporate charitable causes within your estate plan, whether that being making a charitable bequest at your passing, or perhaps a portion of your estate going to fund a private foundation. It potentially provides an avenue for some asset protection to protect family wealth. And then finally, a key aspect not to be overlooked is really to be able to prepare the next generation. So facilitating dialogue and understanding within the family, and ultimately setting them up to be good stewards for the future. I had referenced at the beginning of the presentation just the very favorable exemption amount, and you can see how significantly it jumped from 2017 to 2018 with the passage of the Tax Cuts and Jobs Act. So as a quick reminder, current amount's $13.61 million per person, very favorable, but that amount is scheduled to sunset at the end of 2025. So we're in a key window of opportunity from a planning perspective. So the key takeaway is for individuals who have a taxable estate, or who are likely to have a taxable estate, and who have sufficient assets for retirement, they may want to consider gifting additional assets out of their estate while the exemption's at such a favorable level. We would note that you want to have these discussions earlier rather than later with your estate planning attorney. There's a good chance that estate planning attorneys could be inundated towards the end of 2025 based on tax legislation. So don't wait too long before having that important discussion with your estate planning attorney.
Nick, what do you foresee being the actual temperature and expectations around, will these exemption amounts really sunset, or is there an expectation among the industry that these will be extended by Congress at the last minute?
Yeah, one of our colleagues was able to attend the Heckerling Institute, which is an annual planning symposium, and she recapped that the general temperature among the planning community is that it's likely to sunset after 2025. I think a part of that just speaks to the fact that it's hard to get both political parties to the table to agree on somewhat controversial tax provisions, particularly given that the estate tax actually affects so few estates. So if I had to put a probability, I'd say better than not that the amount lapses, but ultimately remains to be seen. And then recapping on the estate planning front, what are key questions to be asking? First, are your current documents in alignment with your wishes? We often find that clients will draft estate planning documents, but they may be 10 or 15 or 20 years old, and the client hasn't gone back to revisit their estate plan and their wishes. And goals and needs and wishes may change over time. Certainly, we see estate planning levels and provisions change over time, so it's very important to periodically revisit and review estate planning documents. Second, what can you do to reduce your taxable estate, whether that be outright gifts, perhaps charitable gifts, One thing we didn't mention, but that can be a powerful planning tool, are annual exclusion gifts. So that limits $18,000 for 2024. So let's say you had 10 grandkids, you would gift up to $18,000 to each of them each year without that constituting a taxable gift, or as a married couple, up to $36,000 in this example to each grandchild. So that can be a powerful opportunity when it's done on a consistent and disciplined basis year over year. And then finally, is your family prepared to manage your assets when you're gone? Your financial advisor should be able to facilitate those discussions to really ensure that the next generation is educated and prepared to be good stewards of the assets that you've worked so hard to save for. Turning our attention to education planning and recognizing that we're running a little tight on time, we'll go through these last several sections fairly efficiently. But the quick takeaway is most are aware of, the cost of a college education continues to become an increasingly costly proposition. So the College Board puts out an annual trends in college pricing. And when we look at the cost for a public four-year out-of-state university, that all-in cost now is currently about $46,000. Private nonprofit four-year is close to $60,000. So pretty significant amounts. Fortunately, there's a vehicle called the 529 College Savings Plan, which provides a great avenue for parents, grandparents, loved ones to be able to contribute for future education expenses. So from a high level, if we think about what a 529 plan is, I would make the analogy that it's somewhat similar to a Roth account in that while funds are invested within the 529 plan, it's tax-free. And ultimately, qualified education expenses, withdrawals for qualified education expenses are treated as tax-free as well. And there's additionally a provision that allows up to $10,000 for annual withdrawals for K through 12 expenses. So the individual funding the account can be set up as the owner. The beneficiary is not the actual owner of the account. There's flexibility to potentially transfer the benefit to another related family member, should that be of interest in the future. But we really zero in on, when we're thinking about 529 plans, about the potential the longer term tax benefits of funding a 529 account. Also important to note that a number of states provide resident state, either a state tax credit or a state tax deduction for contributions to the resident state plan. So certainly worthwhile to see if your state provides such a tax credit. And then new for 2024, which many individuals certainly weren't expecting, under Secure Act 2.0, there's a new allowance that allows for tax-free and penalty-free rollovers from a 529 to a Roth IRA. There's a number of provisions and parameters set. So it has to be, the 529 plan has to have been in existence for at least 15 years. There's really about 4 or 5 different parameters there, but that is a pretty unique wrinkle as far as 529s are concerned. So really a great avenue to be able to set aside money for future education expenses. Breit, which is the Illinois 529 provider, provided a really nice hypothetical example here of just really the power of compounding over longer periods of time. So looking at an initial contribution and then various monthly contribution amounts, what those amounts might grow over time. So we don't need to belabor this slide, but the key being, much like saving for retirement, the earlier you start and the more consistently you save, the greater the benefit. And given the high cost of a college education, starting sooner rather than later is certainly preferable. So we touched on what is a 529 savings plan. You should be able to speak with your financial advisor to determine if you're on track to be able to pay for the college education. As far as estimating future costs, your financial advisor should be able to model that to see if you're on track. And then importantly, what can you do with funds left over in a 529, as I referenced just very briefly? You can transfer those benefits to a related family member, or you could leave that, for example, to the child. And if they have children at some point, they could use that 529 account for that benefit. And then there's that additional wrinkle that I noted, that starting this year, there's that new provision that will allow for future conversions to a Roth IRA on both a penalty and tax-free basis. So with that, Sarah, why don't we close out on risk management and cybersecurity, and then we'll carve out a couple minutes for questions that individuals have entered in the chat.
Yes, thanks, Nick. And we'll be very brief here in our ending comments. Really want to hone in on best practices as it relates to managing your personal risk. And we're going to pick on property and casualty a little bit today, given that the landscape is very much changing as it relates to property and casualty insurance. So due to the more frequent, intense weather-related events, whether it be fires, hurricanes, and so forth, we're seeing quite the change in landscape. So, as I'm sitting out here in Utah, right, we're one of the trouble states as it relates to fire. We're seeing lots of trouble in Florida and East Coast states as it relates to hurricanes as well. And in some of these states, we're starting to see insurance providers leave the states entirely. We're starting to see deductibles increase substantially. We're starting to see certain coverages being denied, such as hurricane, wind, flood. We're starting to see premiums also increase substantially. So definitely something you want to keep in mind when you're thinking about purchasing a property in one of these states, if it's eligible for homeowners insurance, but also if you live in one of these states, it's something to really zero in on and make sure you review on a periodic basis. We're starting to see some clients actually weigh the pros and cons of carrying homeowners insurance versus self-insuring as well. So you'll want to outweigh, weigh the costs and benefits and whether or not to carry homeowners insurance or to self-insure in some of these more troublesome states as it relates to weather-related events.
So there's a quick question here in the chat. Just what are common mistakes we see among property and casualty insurance?
Yeah, many common mistakes that we see, failing to understand coverage gaps and terms. In your property and casualty, you may need a supplemental umbrella policy. Generally, we like to see umbrella policies or total coverage be about 2 or 3 times your net worth. Another common mistake is that we see coverage covering the market value and not the replacement value of a home, right? It may cost different to rebuild the home than it is necessarily to sell it on the market. And also not revisiting coverages as your net worth changes over time or family conditions might change. So maybe you've got a minor teenage driver now when you didn't have a couple of years ago, that might change your risk outlook as you're reviewing your overall picture. Really, really great question, Nick. And we're going to jump ahead here as we're closing up on time. And just, we don't purport to be cybersecurity or technology experts. We're certainly not a technology firm, but we are in the loop when these types of events of identity fraud and fraud and fraudulent activity happens, because it often happens to financial accounts. So we've included here just some key takeaways on how to prevent, detect, react. By no means is this an exhaustive list, and you'll want to be sure you stay educated and updated as much as you can in these areas. But first and foremost, if you are a victim of identity theft in any regard, be sure to loop in your financial advisor, as again, right, it may have a material impact to your accounts and how those are managed. Lastly, again, as I was mentioning, how do you stay educated on trends in fraud? Many employers nowadays will offer cybersecurity trainings, and not necessarily offer, but mandate, because it is part of our landscape today in the professional world. So take advantage of those, apply those to your personal assets as well, and how you protect your household. You could also check out different resources online. Federal Trade Commission and so forth also has resources online, and you can even sign up for consumer updates in that regard too. So all in, thank you so much for attending our webcast today. We're going to pause here for some questions. By no means did we cover everything in our financial planning guide. You can access it on our website, and be sure to check out our blog throughout the year as well. So let's turn to some of the questions in the last 5 minutes. Do you have access to this presentation? Yes, it's available online on our website, just as I mentioned under the Insights tab. There was a question a little bit earlier around what happens to a surviving spouse. Do they continue to receive Social Security benefits from the deceased spouse? And I'll take that one as I was chatting about it. around the Social Security content. So if the surviving spouse has a lower Social Security benefit than on their own record than their spouse, they would step into the higher benefit. But if not, then they would just continue to receiving their own benefit. The takeaway is that after a death, there is only one benefit left. It's just a question of whether or not you're stepping into a higher benefit, but it's not going to be the full amount that you were both receiving under two different benefits. So really good question that came through the chat. Another question that came through is the taxability of Social Security benefits. Nick, do you want to speak to that and managing taxable income?
Yeah, so typically on Social Security, up to about 85% of the benefit will be taxable. So, a good discussion to be had with your tax advisor, factoring in other taxable income as well as the taxability of your Social Security income. There was a question here on 529 plans. Are owners able to transfer funds to other plans to fund multiple children's Roth IRAs? Under that new provision of Secure Act 2.0, the 529 beneficiary must also be the Roth IRA beneficiary. And there is a lifetime maximum of $35,000 that can be rolled over from unused 529 funds to a Roth. And keep in mind that you'd have to do that in stages because it is subject to the annual contribution limits governing Roth. So for 2024, that limit's $7,000. So it'd have to be a span of multiple years to be able to do that full conversion.
Yeah. Another question has come through around the anticipated medical cost to incur throughout retirement. Does that include Medicare premium? That initial quote that I provided on the front end of the retirement section, that $157,500, is the average total amount spent in retirement for medical costs, which does include those Medicare premiums. So really, really good question.
Sarah, there's a question here on the excess coverage umbrella insurance slide that you covered earlier. For higher net worth families, what's the practical maximum amount of coverage recommended given the likely size of average claims?
Sure. We generally suggest, right, covering 2 to 3 times your net worth. If sometimes your net worth is a little bit higher, right, than what might be available or practical to buy on the market. But in that case, generally $5 minimums on the umbrella policy is generally recommended.
Okay. And keep in mind too, on that umbrella side, to increase your coverage by a couple $1 million, maybe far less than you expect. It might only be the difference of a couple $1,000s in premium per year, depending on the carrier.
Yeah, and perhaps time for one more question. And this is back from the donor advised fund conversation, Nick, surrounding our contributions. How are contributions deductible? Do they differ between the deductibility rates differ if you're funding it with cash versus securities?
Correct. It's 60% for cash contributions and 30% for long-term appreciated securities. So there is a difference there, but again, there is that benefit of using long-term appreciated securities in that you're not having to pay the capital gains tax on that embedded position, and may give you the ability to rebalance or pare back exposure to a concentrated position. There was a related question on that same note. Wasn't there a higher deductibility allowed for cash contributions at one point in time? That's correct. A couple of years ago, I believe that was in conjunction with the CARES Act, Sarah. But 60% is currently the max threshold.
And there's carryover provisions also, right? If you don't use up all of your charitable deductions, so you're capped out by those limits that you were speaking of, you can carry them over to future tax years for a certain number of years.
Yeah, that's a great point. There's a 5-year charitable carry forward. You just need to be careful if you're continuing to make current year contributions because those get used first. So if you do have a charitable carry forward, very good discussion to be had with your tax advisors. As far as thinking about using the charitable carry forward versus do you go ahead with current year charitable contributions?
Yeah. Great. Well, we are at the time for our full 50 minutes today. We thank you all for attending. Again, be sure to click the link for CE credit as was outlined in the chat. And if we didn't get to your question today, I know we had a lot in the chat box. Feel free to reach out to any of us at Fiducient Advisors, myself, Nick, or your personal connection at Fiducient Advisors as well. We'd be happy to have a follow-up call. So thank you again. We hope your week is off to a good start and have a great day.
Thank you, everyone.